The majority of individuals who enter the market are consumed by a single overriding objective: not to lose money. They play a defensive game, driven by the fear of loss. They take small profits quickly, afraid they might vanish, and they hold on to losing positions, hoping they will recover. Yet the secret to accumulating vast wealth lies not in the timid preservation of capital, but in the aggressive maximization of correct judgments. The greatest profits are not made by being right many times, but by being very right on a few critical occasions. The most logical and paradoxically the safest method for transforming a small stake into a substantial fortune was a cornerstone of Jesse Livermore's strategy. It is a technique known as pyramiding. This is not the reckless gambling it is often mistaken for. It is a cold, calculated method of offensive speculation, a way to compound the power of a correct decision and turn a modest $1,000 position into $100,000. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. To understand the power of pyramiding, one must first confront its destructive opposite, the most common and ruinous mistake in the entire field of speculation: the practice of averaging down a losing position. This is the great financial heresy to which countless traders, both novice and experienced, have fallen victim. The scenario is universally familiar. A speculator buys a stock at 50, confident in its prospects. The next day, it is at 47. Seized by what seems like a logical impulse, he buys another 100 shares to average down, making his average price 48.5. His reasoning is simple. If it was a good buy at 50, it must be an even better bargain at 47. He is not buying more because his judgment has been confirmed. He is buying more because his judgment has been challenged, and his ego cannot accept the possibility of being wrong. He is sending, in Livermore's own words, good money after bad. Livermore viewed this practice with absolute contempt. He considered it the cardinal sin of speculation. He wrote with brutal clarity, "Great numbers of people will buy a stock, let us say at 50, and 2 or 3 days later, if they can buy it at 47, they are seized with the urge to average down. Having bought at 50 and being concerned over a 3-point loss on 100 shares, what rhyme or reason is there in adding another 100 shares and having the double worry when the price hits 44? The logic is inescapable. If the initial commitment was concerning, doubling that commitment in the face of a loss is an act of financial self-destruction. The speculator who averages down is not operating on evidence, he is operating on hope. He is substituting a wish for a plan. He hopes the market will reverse. He hopes his initial judgment will be vindicated. He hopes he can escape his predicament. Hope in a losing position is a speculator's most lethal enemy. The psychology behind this error is deeply rooted in human nature. First, there is the powerful desire to be proven right. Taking a loss is a direct admission of a mistake, an affront to the ego. Averaging down is a way to postpone that admission, to tell oneself, I am not wrong, I am just early, and now I am getting an even better price. Second, there is the fear of crystallizing a loss. As long as the position is open, the loss is only on paper. The act of selling transforms it into a real, tangible deficit. The amateur trader will do almost anything to avoid this moment of truth. Finally, there is the illusion of the better average price. The mathematics seem appealing, but they mask a fundamental fallacy. The speculator is not improving his position. He is increasing his risk. He is doubling down on an error. Livermore was adamant. Never average losses. Let that thought be written indelibly upon your mind. The only tip he ever trusted from a broker was a margin call. When it reaches you, close your account. You are on the wrong side of the market. Averaging down is simply a voluntary, self-inflicted margin call on one's own capital. Having established this absolute don't, Livermore built his entire offensive strategy on its polar opposite. The first principle of pyramiding, The foundational rule from which all else follows is that one must always buy on a rising scale. He stated it as a simple, unbreakable law. Each succeeding purchase must be at a higher price than the previous one. This is the intellectual and psychological core of his method. Where averaging down is an act of hope in the face of negative evidence, buying on a rising scale is an act of confidence based on positive confirmation. Each new purchase is not a blind guess. It is a response to the market's own validation of your initial judgment. The market itself is telling you that you are right. The logic is simple but profound. A speculator's job is not to impose his will on the market, but to align himself with the market's dominant force. When a stock is advancing, it is demonstrating that the buying pressure is greater than the selling pressure. The line of least resistance is upward. To buy at that moment is to move with the current, not against it. Each new high the stock makes is further evidence of this underlying strength. Therefore, each additional purchase at a higher price is made with a greater degree of certainty than the one before it. The risk is not increasing. It is being progressively validated. Livermore did not see this as becoming more aggressive. He saw it as deploying his forces intelligently, committing more capital only as the evidence of victory mounted. He laid out the mechanics of this with perfect clarity. Let us suppose that you want to buy 500 shares of a stock, he explained. Start by buying 100 shares. Then if the market advances, buy another 100 shares and so on. This is not a haphazard process. It is a systematic expansion of a position based on market feedback. The speculator is not taking a single large bet on his opinion. He is initiating a series of smaller conditional bets, each one contingent on the success of the last. This transforms speculation from a single high-stakes gamble into a logical, evidence-based campaign. The goal is not merely to be in the market, but to be in the market with size only when the market is moving decisively in one's favor. The pyramid is built on a foundation of strength, not on the shifting sands of hope. This leads directly to the second and equally critical principle of the pyramiding foundation. Your very first trade must show a profit. This is the gatekeeper of the entire strategy. If the initial commitment fails this test, the pyramid is never built. Livermore discovered this truth through years of observation and painful losses. Experience has proved to me, he wrote, that the real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start. He came to view his first entry not as the start of a final position, but as an exploratory bet, a probe sent out to test the market's intentions. The purpose of this initial trade is to answer one question: is my timing correct? A speculator can have the most brilliant analysis of a stock's fundamental value and the market's general condition, but if his timing is off, he will lose money. The market itself is the only true judge of timing. Therefore, when Livermore made his first purchase, he expected an immediate validation in the form of a profit. If he bought a stock and it immediately began to decline or simply did nothing, it was a clear signal from the market that his timing was wrong. I was wrong, he would conclude. It might be I was only temporarily wrong. But as I have said before, it does not pay to start wrong in anything. The correct action in this scenario was not to wait, not to hope, and certainly not to buy more. The correct action was to close the trade immediately, take the small, predefined loss, and step back to reassess. This initial testing trade is the primary risk control mechanism of the entire pyramiding strategy. It ensures that any losses are small and contained, while only a position that is immediately proven correct is allowed to grow. This two-part principle, making the initial trade a test and then pyramiding only on strength, is a complete reversal of the amateur's mindset. The amateur seeks the bottom, hopes for a turnaround, and compounds his errors by averaging down. The professional waits for confirmation, acts on evidence, and compounds his correct judgments by pyramiding up. This is the shift in thinking from a defensive, loss-focused approach to an offensive, profit-maximizing one. It is the understanding that the goal is not to avoid all losses, but to ensure that the wins are exponentially larger than the losses. Pyramiding is the mechanical tool for achieving this asymmetry. It is the engine that transforms a small, correct judgment into a massive, life-changing profit. This strategic approach of waiting for confirmation and then acting aggressively aligns perfectly with the work of another market master, Richard Wyckoff. While Livermore's method tells you how to act once a trend has begun, Wyckoff's methodology provides a brilliant framework for identifying when that trend is most likely to start. Wyckoff taught that major market movements do not happen randomly. They are preceded by periods of preparation. His analysis of market phases, specifically the transition from a sideways accumulation phase to a powerful trending markup phase, is the key to understanding the ideal territory for Livermore's pyramiding strategy. A speculator who simply tries to pyramid any stock that is going up may be doing so at the very end of its move. But a speculator who has learned to identify the signs of a Wyckoffian accumulation phase, the period where smart money is quietly absorbing shares, can then apply Livermore's pyramiding tactics with explosive results right as the markup phase begins. The combination of these two approaches is incredibly powerful. Wyckoff gives you the map to find the starting line of the race, and Livermore gives you the instructions on how to run that race for maximum speed and profit. For anyone who wishes to master this crucial skill of identifying the market's true readiness for a major trend, the Richard Wyckoff Trading Methods channel is an essential resource for study. It provides the logical structure that turns Livermore's aggressive tactics into a complete and robust trading system. You can find a link in the description. By understanding when to act, the method of how to act becomes infinitely more powerful. The foundational principles of pyramiding, to buy on a rising scale and to cut losses on the initial exploratory bet, represent a radical departure from the instincts of the average speculator. They demand a shift in thinking from a defensive posture of loss avoidance to an offensive strategy of profit maximization. However, possessing the correct philosophy is not enough. To successfully build a $1,000 position into $100,000 requires a mastery of both the mechanics and the psychology of the process. A speculator must know precisely when to begin his campaign, how to manage the risk of an expanding position, and how to cultivate the psychological fortitude necessary to hold that position through the inevitable trials of a major market movement. Jesse Livermore, through decades of trial and error, refined these elements into a cohesive and powerful methodology. The first and most critical element in the mechanics of a successful pyramid is timing. The decision of when to make the first commitment is paramount. An entry made too early into a market that is not yet ready to move will result in a small loss and a missed opportunity, as Livermore's cotton disaster so painfully demonstrated. An entry made too late will mean missing the initial backlog of profit that is essential for providing the courage to hold the position through its full course. Pyramiding cannot begin at just any time. It must begin at the exact moment the market signals its readiness for a major, sustained move. Livermore's tool for identifying this moment was the pivotal point. He wrote, "Whenever I have had the patience to wait for the market to arrive at what I call a pivotal point before I started to trade, I have always made money in my operations." This was not a guess. It was the cornerstone of his entire timing strategy. A pivotal point in Livermore's system was a specific price level that had historical or psychological significance. Once this level was decisively breached, it indicated that the balance of power between buyers and sellers had shifted, and the line of least resistance was now clearly established. He identified several types of these critical points. The most obvious were the major round number barriers. Prices like 50, 100, 200, or 300. He had frequently observed that after a stock passed such a point for the first time, a fast and straight movement almost invariably occurred. His successful trades in Anaconda, where he bought the stock as it crossed 100, 200, and 300, were textbook examples of this principle in action. Another type of pivotal point was a brand new high price for a stock that had been dormant for a long period. This signal indicated that something fundamentally positive had changed with the company, and all previous overhead resistance had been overcome. Usually it is a safe play to buy the minute it touches a brand new high, he advised. Conversely, a stock breaking below a significant previous low was an equally powerful pivotal point to the downside. The purpose of waiting for these points was to avoid the frustrating and capital-draining experience of being locked in a get-nowhere market. He would not commit his first exploratory share until the market itself had given him this clear and unambiguous starting signal. Once the pivotal point was crossed and the initial exploratory position was taken and confirmed with a profit, the process of building the pyramid began. It is here that the myth of pyramiding as a form of reckless gambling must be dismantled. When executed correctly, the Livermore method of pyramiding is a sophisticated form of risk management. The key is to understand that the speculator's original capital is only at significant risk on the very first trade. Every subsequent addition to the position is made on the back of an existing paper profit. Livermore never used his original capital to add to a position. He used the market's money. The profit from his earlier trades acted as a buffer or a margin for his later ones. Let us illustrate this with a concrete example, following his own principles. A speculator with an initial $1,000 of risk capital identifies a stock trading in a range and sets a pivotal point at $50. He waits patiently. The stock becomes active and decisively trades at $50. He makes his first exploratory bet, buying 20 shares for a total of $1,000. His maximum risk is now defined. He might, for instance, place a stop loss at $48, limiting his potential loss to $40 plus commissions. The stock, however, acts as it should and advances to $52. His initial position now shows a profit of $40. He's been proven right. Now he makes his second purchase, buying another 20 shares at $52. His total position is 40 shares with an average price of $51. The stock continues to advance to $54. His total position is now worth $2,160 against a total cost of $2,040, giving him a paper profit of $120. Notice what has happened. He has doubled his position, but his original $1,000 is no longer at risk. The $120 profit serves as a cushion. He can now move his stop loss for the entire position up to his average cost of $51, ensuring that, at worst, he will break even on the campaign. His original risk capital is safe. As the stock continues to advance, say to $57, his profit grows. He might then buy a third lot of shares, again using his paper profits to finance the margin. The process continues, with the speculator adding to his line on a rising scale and with each addition, moving his stop loss up to protect his accumulated gains. The pyramid is built not by adding risk, but by compounding a correct judgment while systematically removing the risk to one's original capital. This is the very opposite of the reckless plunger's approach. It is a cold, calculated business method. Livermore did not simply hope a stock would go up. He demanded that it prove it to him every step of the way, and he only increased his bet as that proof was delivered. The pyramid, therefore, is not a house of cards. It is a fortress built upon a foundation of confirmed market strength, with each new layer financed by the success of the one below it. With the mechanics of timing and risk management in place, the final and most difficult challenge of pyramiding presents itself: the psychological battle of holding a large, profitable position. It is one of the great ironies of speculation that it is often far more difficult to hold a winning trade than to cut a losing one. The amateur speculator is tormented by the fear of losing his paper profits. Every minor, normal reaction in the market feels like the beginning of the end. The temptation to cash in and secure the gain becomes almost unbearable. This is the fear that prevents a trader from capturing the truly great movements, the moves that turn a small stake into a fortune. Jesse Livermore understood this battle intimately. After attaining a goodly profit, You must have patience, he wrote. But don't let patience create a frame of mind that ignores the danger signals. The key to this patience, he discovered, was directly linked to the very structure of the pyramid. The psychological stability required to sit tight comes from the backlog of profit that a correctly built pyramid provides. I missed the backlog of profit, he said of his cotton failure, which is very necessary to provide the courage and patience to sit through a move until the end comes, and to stay through any minor reactions or rallies which were bound to occur. The speculator who has pyramided his way into a large position from a low initial entry has a substantial cushion. When the stock has a natural reaction of a few points, he is not threatened. His position remains profitable. He can view the reaction dispassionately as a normal and healthy part of the trend. He can analyze its character, noting whether it occurs on light or heavy volume, and make a calculated decision rather than a panicked one. But the speculator who entered late, or who has a high average cost with little to no profit, experiences every dip as a direct threat to his capital. He is driven by fear, not by judgment, and is almost certain to be shaken out of his position at the worst possible time. The profit created by the pyramid is not just a financial asset, it is a psychological shield. It is the source of the courage required to let a profit run. This is the essence of the Livermore method for transforming a small position into a large one. It is a complete philosophy that begins with the humility of patience, waiting for the market to give its signal at the pivotal point. It proceeds with the logic of a scientist, testing the market with an initial probe and demanding confirmation in the form of a profit before committing further. It builds with the strategy of a general, deploying more forces only on the ground of proven success, always protecting his base of original capital. And finally, it requires the fortitude of a stoic, the ability to sit with a winning position, to endure the normal ebbs and flows of the market, and to hold that position until the market itself, through a clear danger signal, announces that the great move has run its course. This is not gambling. It is not a quest for easy money. It is the application of sound business principles to the art of speculation. It is a method that demands discipline, study, and an unwavering respect for the market's supreme authority. It is, when mastered, the most logical path from $1,000 to $100,000. These principles, which allowed Jesse Livermore to transform small stakes into enormous fortunes, are the central recurring theme of his legendary career. His life was a continuous laboratory for testing and refining these very ideas. To truly understand the depth of this philosophy, one must go beyond the rules and enter the mind of the man who created them. Edwin Lefebvre, in his masterpiece Reminiscences of a Stock Operator, does not just recount the stories of Livermore's successes. He immerses the reader in the very thought process, the internal debates, and the psychological battles that stood behind every major trade. The book is not a historical account. It is a living, breathing education in the mind of a master speculator. To fully grasp how to apply the psychology of pyramiding, to feel the anxiety of the wait, and the conviction of the final commitment, reading Reminiscences is essential. And to translate that century-old wisdom into a practical, actionable plan for today's markets, the chapter-by-chapter analysis by Max Davidson serves as your personal mentor. This analysis dissects each trade, each mistake, and each triumph not as a story, but as a case study in speculative thinking, transforming the timeless wisdom of Livermore into a modern blueprint for action. The link is in the description.